Hey everyone, welcome back to the channel, MyLatinLife, and today we're going to be talking about claiming U.S. tax deductions on foreign real estate. So whether you're considering purchasing a vacation home overseas, a rental property, or even planning to retire abroad, there are several tax benefits you should know about. Some of the U.S. tax rules you're familiar with apply regardless of whether your property is in the States or overseas, but there are some key differences as well that you'll want to be aware of. So in this video, we're going to break it all down. So first, let's talk about tax treatment of foreign versus domestic property. How does the tax treatment of foreign property compare to property in the U.S.? Well, in many ways, it's actually quite similar, and I would say surprisingly similar. I think a lot of people have this preconceived notion that foreign property doesn't have the tax benefits that U.S. property does for U.S. citizens because it is a very tax-advantaged asset class. But I think what you'll find as you dig into it is that foreign property and property overseas, really you still get a lot of the same benefits. The big thing to remember is that you can generally claim tax benefits like the mortgage interest deduction and things like that on properties located abroad. This is just like you would for a home in the U.S. But keep in mind there are a few exceptions that we'll get into, so stick with me. But bottom line, things actually are more positive than you might have anticipated in terms of all the tax breaks that are available to you. So now let's talk about the mortgage interest deduction specifically. If you live in or use your foreign home as a second home, you can deduct mortgage interest on that property. The limits are the same as for U.S. homes, up to $750,000 of secured mortgage debt for both your first and second home combined, or $375,000 if you're married and filing separately. Now, if you bought your property before December 16th, 2017, the deduction cap is a bit higher, $1 million. And that's an important date to remember when claiming deductions on older properties. But here's one key thing. Expenses like utilities, maintenance, or insurance aren't deductible unless you qualify for the home office deduction. So if you're not using the property for rental income or a business, those costs are on you. I think things get interesting when the foreign property is a business, and I'll get to that in this video. Next, let's talk about foreign property taxes. So if you're hoping to deduct foreign property taxes on your U.S. tax return, I do have bad news on this one. Foreign property taxes haven't been deductible since 2017, and that rule is in place until at least 2025. After that, unless Congress steps in, things may change, so stay tuned on that front. The good news, by the way, in Latin America is that property taxes are really, really low in most Latin American countries. In El Salvador, there's no property tax. In Mexico, it might be a couple $100 a year, so not the biggest deal, depending on the country. Now let's talk about foreign rental property rules. So if you're renting out your property abroad, the tax situation gets a little more complex. The IRS divides foreign property into two categories: personal residence and rental property. Here's a quick breakdown. If you rent out your home for 14 days or less in a year and use it more than 14 days or 10% of the days it's rented, the IRS considers it a personal residence. In this case, you don't have to report the rental income, no matter how high it is, right? So you only rented it out. You can basically rent out your property for up to 14 days tax-free. If you rent out for more than 14 days and use it for personal purposes, less than 10% of the total rental days, the IRS treats it as a rental property. This means you have to report all rental income, but the upside is you can deduct rental expenses like mortgage interest, insurance, repairs, and even property manager fees. One important thing to note, when a family member stays at the home, even if they're paying rent, it's considered personal use, unless you're charging fair market value for the stay. So make sure you're keeping good records. Next, let's talk about depreciation and 1031 exchanges. Now, depreciation, pretty clear cut. 1031 exchanges, I've seen different things from different sources. So again, I'm not an international tax lawyer. I'm just a guy on the internet who occasionally makes some good points. But here's what I've gathered so far. Foreign rental properties are depreciated over 30 years, unlike domestic U.S. properties, which are depreciated over 27.5 years. Remember, only the value of the building itself is depreciable. The land doesn't count. And you'll have to do a thing to sort of assess the fair market value of the land and the building. Now, if you decide to sell your foreign property, there's something called a 1031 exchange, which lets you defer capital gains taxes by exchanging one investment property for another. But here's the catch. You can only exchange foreign property for another foreign property. You can't do a 1031 exchange between a U.S. property and one abroad. It's important to know this if you're thinking about making a switch from one international property to another. And the way I've had this explained is that the 1031 exchange, it's what's the term? It's like a like use or like property case. And so you can do U.S. to U.S. because that's a like thing. But you can't do international to U.S. or U.S. to international because that's not considered a like asset. But you can do international to international because that's considered a like asset. And my understanding is you can do from one country to another. So you could exchange from, say, a property in Ecuador to a property in Portugal, or from a property in Portugal to a property in Mexico. Basically, anything international is considered a like asset. Okay. Now let's talk about capital gains on foreign property sales. So what if you sell that foreign home? If it's been your primary residence for at least 2 out of the last 5 years, you can exclude up to $250,000 of capital gains and up to $500,000 if you're married filing jointly. This exclusion applies just like it does for U.S. properties, which is pretty cool. However, if it's not your primary residence, you'll be subject to capital gains tax on the full amount. The good news is that you may be eligible for the foreign tax credit on your U.S. tax return if you've already paid capital gains taxes in the country where the property is located. Just remember, you can't claim the foreign earned income exclusion for gains from selling your foreign property. The foreign earned income exclusion is for earned income, and selling a property is capital gains. So those things are different. Next, let's talk about reporting requirements and avoiding double taxation. So owning property abroad comes with some additional reporting requirements. For example, if you open a foreign bank account to manage the rental income and the total balance of your foreign accounts exceeds $10,000 at any point during the year, you'll need to file an FBAR, a report of foreign bank and financial accounts. You might also need to file a Form 4571 if you own the property through a foreign corporation, or a Form 8858 if it's held through a foreign LLC. Double taxation is always a concern when owning foreign property, but the U.S. tax code does allow for foreign tax credits to prevent this. So if you pay taxes in the country where your property is held, you can claim a credit on your U.S. tax return, the foreign tax credit. And by the way, guys, we have other videos on the MyLatinLife channel talking about the FBAR, the foreign bank account reporting. So just search the videos on our channel, search FBAR, the acronym FBAR, and that should pop right up. We have multiple videos on it, actually. All right, so that's a lot to take in. But if you own or are thinking about buying foreign real estate, understand how U.S. tax law treats your property. Understanding how U.S. tax law treats your property is crucial. The key takeaway here is that while many of the tax benefits are similar to those for U.S. properties, there are some unique rules and filing requirements you need to know about. I think overall, there's more benefits than people realize, and you get most of the benefits you get from U.S. property with some minor quirks and differences. But, I thought as an expat that you wouldn't get like any benefits on foreign property. So I think things are actually looking up. I think we get more benefits than you would realize. So that's pretty good. As always, of course, it's best to consult with a tax professional, especially when dealing with international properties. It can get complicated, and you don't want to miss out on any deductions or credits you're entitled to. Also, if you would like to work with My Latin Life on anything Latin America, we work with every single country in Latin America, whether it's Mexico, Panama, Argentina, Costa Rica, any country in Latin America. We can help you with residency. We can help introduce you to real estate agents, to lawyers, accountants, all that good stuff. We can help you make a holistic plan. Maybe you're looking to relocate to Latin America or simply set up a plan B for yourself and or your family in Latin America. If any of these things are the case, book a call with us. There will be a link in the description. We've helped dozens, hundreds, even thousands, you could say, of people to help them move to Latin America and set up plan Bs in Latin America. So we're ready to speak with you as soon as you book a call. And if you found this video helpful, don't forget to give it a thumbs up, subscribe for more insights on real estate, life, investing, and living abroad, and we'll catch you in the next video.